BlackRock is the biggest financial organization in the world, with assets worth $10 trillion and a presence in 30 different nations. Additionally, it manages an additional $21.6 trillion through the use of the Aladdin program, which analyzes and keeps track of investor portfolios. It completely rules this market and has been hiring and snatching up as many government employees as they can, even senior advisors to several presidents in recent years. Despite this, only 1% of individuals can name Larry Fink, the founder and CEO of BlackRock, or even describe his appearance. The fact that there are so many diverse theories on how much influence BlackRock has over the world is not surprising. And when BlackRock publicly declares that a new world order is about to emerge, everyone with even a modest amount of intelligence will pay attention. BlackRock has issued their 2023 Global Investment Outlook, which details exactly what is happening right now and what will happen over the course of the next year. The piece's undertone is obvious throughout: a fresh playbook, a new regime in action, and even a new global structure. Hey, welcome to Stock Market Mate. In today's video, we will verify the specifics of what is taking place and the reason why nobody is raising the issue previously mentioned. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. What then is BlackRock asserting to be taking place at this very moment? All things considered, they appear to believe that during the coming 10 years, things will actually change and that the recent period of cheap interest rates and rapid economic expansion will not be repeated. They refer to it as a new supply-driven regime, with markets and economies finding it difficult to adjust to shifting demand in the post-COVID environment. In essence, they believe that the days of new automobiles selling as soon as they arrive at the dealership, PlayStation 5s being completely sold out, and speculating buying of expensive items like Rolex watches will never end. There are many causes for this, including the ongoing interruptions to China's supply chains, which prevent these enterprises from increasing their supply to meet demand. But there's also the issue of the global labor shortage, which will only become worse as the world's population ages and becomes less labor-intensive overall. Look at the population decline in nations with significant manufacturing bases, such as Japan, China, and Italy. The core issue in the falling working-age population will be immediately apparent. As a result, businesses that will grow their supply also boost inflationary pressures because there will be a greater need for capital to build warehouses, factories, and even hire more workers. BlackRock believes that this is the reason why inflation has remained high long after the initial pandemic has passed. BlackRock notes that central banks are attempting to bring inflation down by hammering demand with interest rate hikes and quantitative easing because the supply chain crisis has never really healed itself. As a result of the recession it will cause, this is a cruel trade-off. These central banks simply lack the resources necessary to alter supply in order to reduce inflation. As a result, they have resorted to just hammering demand, which according to BlackRock indicates that a recession is predicted and that signs of it are beginning to appear. Even worse, there are two more variables that will guarantee that inflation stays high for the foreseeable future. The first is that supply networks are being impacted by escalating geopolitical tensions. The apparent Russian invasion of Ukraine and the West serves as a clear-cut example of this new Cold War between the East and the West. Another factor is the United States' limits on the export of Chinese microchips. These are smaller and less noticeable tax exchanges. The global shift to net zero, according to BlackRock, will affect both the supply of energy and inflation. Unbalanced demand has already caused an increase in energy prices. There's already a ton of evidence to support this. Because of the global energy crisis, both the cost of electricity and the price of crude oil have risen sharply and steadily. BlackRock believes the persistently high inflation is here to stay, but it won't remain stable in the US and Europe indefinitely. A global recession will already be well underway by the time it is dragged down by 4 or 5%, and central banks will lose their composure, stop raising interest rates, and inflation will continue. Our bottom line, as BlackRock so beautifully phrased it, is that what worked in the past won't work now. People will be wondering how we should respond to this news as a new world order is emerging as BlackRock themselves have designed it. Should we disregard caution and keep making risky investments in speculative assets like cryptocurrencies? Should we perhaps follow Bill Gates' example and acquire as much farmland as we can afford? Here, though, we must be skeptical of what BlackRock says since we can never be certain of what truly occurs behind the scenes. They have cast double on their strategy for profiting, making money, and expanding. We already know BlackRock anticipates a recession to occur when this new world order begins to take hold, as well as the inevitable after effects of recessions. A stock market crash, of course, if you ignore the fact that the S&P 500 fell by more than 25% and the Nasdaq fell by 35% at their lowest points. However, according to BlackRock, things are only going to get worse, and stock markets will continue to decline through 2023 because the recession has scarcely really begun and will only grow worse. As proof of this recession, they're citing leading indicators including plummeting home sales, declining CEO confidence, and falling consumer savings. However, the evidence truly doesn't end there. According to BlackRock, The markets haven't factored in the fact that corporate earnings will suffer during the current recession, which seems to be exactly what prominent investor Michael Burry has been predicting for months. Stocks can only move down because a recession, even a minor one when it occurs, has not yet been factored into the market's prices. Bonds have historically had a position in the portfolios of many investors, and BlackRock and its recommendations have shared this trend for many years. They do, after all, offer a steady and dependable return and are supported by the might of our governments. BlackRock, however, is altering its perspective on bonds and actually disliking long-term treasury bonds. They have been applied to protect investors against economic downturns. Bond prices would rise when equities did, but in recent years, they've been moving in the same way. They anticipate bonds to decline as well since they believe that stocks will continue to decline. Instead, they're focusing more on short-term bonds, which carry a marginally higher risk but offer a higher yield than bonds that are linked to inflation. Outside of those obvious reasons, BlackRock is moving in a route that is actually open to the majority of us. They're purchasing investment-grade credit and mortgage-backed securities. It might be a good thing. We don't have access to these possibilities because BlackRock itself anticipates a decline in the housing market, and we all remember what happened to mortgage-backed securities in 2006 when that occurred. BlackRock advises investing in healthcare, energy, and financials if you do decide to buy stocks. The last several pages of their worldwide market overview, however, read almost exactly like a sales presentation for potential customers. They assert that a fresh, quick-to-adapt strategic strategy is required in order to deal with shifting economic conditions and the macro environment, compared to the earlier investment fad of making a single, monthly contribution of a few $100s to an S&P 500 index fund. Here we must use extra caution. BlackRock is first and foremost a company, and as a company, it owes it to its shareholders to maximize profits at any cost. If Larry Fink discovers a technique to increase profits but decides against directing the business in that direction, he may be held legally liable for breaching his obligations to the business. Regarding the 2023 prognosis that they have published, concerns must be raised regarding both its objectives and its content. In the last few chapters, it is explained in further detail why only BlackRock can provide continued high returns because only they have a thorough understanding of the situation. Investing in some of BlackRock's active funds, which move swiftly and strive hard to make their clients money, seems to be the answer to all of our investment issues. However, these active funds also put in a lot of effort to increase their own income. How much money does BlackRock make annually for every $1,000 put in one of their passive investment funds? 30 cents. When you put the same amount in the active fund, how much do they make? They generate 23 times more revenue. It makes sense that they would want us to think that their active funds are the only thing that can move us forward, since it is profitable for them to do so. There is also the enormous problem of BlackRock's power itself. Many people allege that BlackRock is secretly pulling the strings and acting as a puppet master to government agencies, businesses, and citizens. Simply put, we cannot believe whatever they say. Many contend that BlackRock has no control and is only the custodian of those assets. However, that didn't stop them from removing 3 ExxonMobil board members and replacing them with those they wanted to lead the company. BlackRock even made the same attempt to discredit Elon Musk with Tesla in 2018. But they were unsuccessful since Elon controlled sufficient shares of the firm to thwart their plans. BlackRock isn't the only method to make your assets work for you. And just because they claim to know their secrets of the New World Order doesn't mean you should believe them or align yourself with them. Like every smart investor, always do your due diligence. Well, that's about it for today's video. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you in the next one. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!